All of a sudden, the debate about the economy has shifted. No one's asking when the recession is going to end. They're talking about the pace of recovery. And of course, where you stand in that debate has big implications for how you invest. P.I.M.C.O is the world's biggest bond investor, and Richard Clarida is one of its top economists, not to mention professor of economics at Columbia University and assistant Treasury Secretary under George W. Bush. He's here to share his views on that very debate. Richard, just a couple of days ago, John Herman, who also teaches at Columbia on occasion, of Herman Forecasting, was here, and he said the economy is, quote, really starting to heal itself, coiling for a big expansion before the end of this year. And with yesterday's monthly gain in home prices and, of course, the gain of more than 10% that we've seen in stocks over the past 2 weeks, more and more people are thinking that maybe a guy like John Herman is right. Why would they be wrong to think like that?
Well, the economy, I think, probably has bottomed. We'll have negative growth in the second quarter. I see positive growth beginning in the third quarter, but I don't see a traditional gangbusters recovery. I think recovery on average of around 2% growth. As Bernanke said this week, continued high unemployment. Now, why is that? Well, the U.S. consumer has been the engine of U.S. and global growth really for 25 years, and the consumer's tapped out. And since consumption is 70% of the economy, it's really hard to get a robust traditional V-shaped recovery, and that's why I see modest growth.
Is it too early, though, to say that the recession is, quote-unquote, over?
Yes, and in fact, that official determination probably will not be made for several months. But once we start to get positive growth, the recession probably has come to an end, yes.
What are the biggest headwinds, Richard, that you still see? I mean, is it consumer credit? I mean, is it commercial real estate? I mean, where are the other shoes to drop?
Well, where do I begin? All the above. Consumer credit, the consumer, as I said, is tapped out. Commercial real estate is still an overhang for the banking system. The global economy is in a recession. So, yeah, a lot of headwinds down the road, yeah.
Richard, just a couple of days ago on Monday, Janet Yellen talked about a painfully slow recovery. How long, in your opinion, until we get back to where the economy was before in terms of output? Effectively, how long before we can say that the economy has, quote-unquote, recovered?
Well, I think output may recover within a period of 2 or 3 years. But in terms of the unemployment rate's going north of 10%. And it may be into the second Obama term, if there is one, before the unemployment rate is back down below 6%.
Okay. That actually brings up an important question, because you folks at P.I.M.C.O talk about the new normal, a GDP growth rate of about 2% a year. What kind of unemployment rate are we likely to see in that new normal environment?
Well, I think the unemployment rate will probably peak at around 10.5%, and then it will begin a very, very slow process of being reduced and falling. But as I said, that process will be slow, and unemployment will probably stay above 7% for the next several years anyway.
So even the improvements that we've seen in sort of the weekly data, even the 4-week moving average, I mean, a lot of people are reading optimism into this, but you say that's sort of a false signal of hope?
Well, I think we've seen the worst. The economy has been contracting. That process is coming to an end. The labor market is lagging. And I think, you know, if you're unemployed, you know, the old saying goes, if you're unemployed, it feels like a depression, not a recession.
Richard, if people think like you think, with the slow recovery in jobs, for example, the so-called jobless recovery, the outlook that you have for growth, what are the implications for investors? What kind of investing conditions are we likely to see in terms of the inflationary pressures and other things that investors like you at P.I.M.C.O need to keep in mind?
I think there are 3 points. One, near-term inflation is not really a risk in the next year or so, but down the road there's a potential upside risk to inflation, especially with strong commodity prices, a weaker dollar. I think another factor is, again, we've had 25 years of a consumption boom in this country fueled by higher leverage. What does the economy look like in deleveraging with slower growth? It probably means less opportunities in terms of double-digit earnings, in terms of equities, and it means important implications in the fixed income markets, given all this increase in Treasury supply with the budget deficits.
Now, speaking of corporate earnings, have you been surprised? I mean, you have to follow earnings. You're not a forecaster of earnings, but you follow earnings. Have you been surprised by the better-than-expected earnings we've seen from some of the big companies in the S&P 500,
There have been some positive surprises, but again, in context, earnings year over year are still declining, and this is a very, very steep earnings contraction that we're in. At some point, it will bottom out. But I think, importantly, a lot of earnings growth in the past has been driven by earnings per share with share buybacks. That's going to be less common. So I think that's an important factor there.
Is there a risk, though, in investors deceiving themselves, watching these earnings reports into thinking that the health of corporate America is better than it actually is?
Well, I think that the health of corporate America in the non-financial sector is pretty good. I think the financial sector, of course, took a huge hit. And at the peak of the credit bubble, financial earnings were a big share of overall earnings. So it's not clear to me, even after the economy rebounds, that we're going back to where we were with the oversized role of finance in earnings.
Okay, Richard, please sit tight. We're going to be back with you in just 2 minutes. We're back now with Richard Clarida, Global Strategic Advisor at P.I.M.C.O, Professor of Economics at Columbia University, and a former Assistant Treasury Secretary under George W. Bush. Richard, just before the break, we were talking about the stock market.
Yeah.
Alan Greenspan talks about the potential impact that rising stocks can have on business confidence, investment. We've seen stocks gain more than 10% in the past 2 weeks.
Yeah.
How much of that should we factor into our outlook for the economy?
No, it's obviously a positive, and it's a positive that we've moved past the pessimism of early this winter. I think the real question for stocks is, what have you done for me lately? It's going to be tough in my mind to have another 6 months like we've had in the last several weeks in terms of big rebound from the lows. Stocks are still well below their highs, and I think it will take some time before we get close to those levels.
Is that representative of the rally that we've seen sort of in the past 6 months? I mean, we were all just talking during the break, and you said, we've really moved beyond the panic stages of, for example, after Lehman Brothers collapsed. So are we in a little bit more of an optimistic investing environment? It seems as if we are.
Oh, absolutely, yeah. There's no question about it. The risk appetite has returned. You see it in emerging market equities. You're seeing it in the commodity markets. And that's a positive, obviously. You don't want to be in the world that we were in September after Lehman and AIG.
Richard, you wrote in a recent essay about the credit boom and bust cycle, leverage, and inflation. What does the state of the credit markets right now tell you about the potential for GDP growth? What should we be watching?
Well, credit really fueled the boom of the last 25 years and higher leverage, and the ongoing deleveraging will continue. I think credit spreads, which are an indicator of the concern about default, credit spreads are narrower, but they're still elevated because they reflect the weak economy. So I think credit markets now are in better balance, but I certainly think that we continue to have, as I said, a really weak economy, and that will weigh on the credit markets to some extent.
One last thing I want to get to, Ben Bernanke, Nouriel Roubini, Anna Schwartz squaring off in the New York Times on the op-ed page this weekend over his prospects. Nouriel saying he should be reappointed. Anna Schwartz, collaborator with Milton Friedman, saying he should be kicked out and replaced. Where do you stand? You were once considered as a potential replacement for Mr. Greenspan yourself.
Oh, no, I'm not sure about that. But I think Bernanke's done a fine job. I've known Ben for 25 years, and certainly, as they say in the Olympics, degree of difficulty in the diving competition, he certainly has excelled even under those. So I would certainly hope that the president does reappoint him.
Okay, very good. So,
thank you.
Richard Clarida joining us here, siding with Nouriel Roubini on the subject of Ben Bernanke's reappointment. We thank you for joining us. Hope he comes back soon.